Hey, house stackers, welcome to episode number 36 of the Stacking Houses podcast, where we're helping working professionals create a solid plan B, a side hustle of passive streams of income through real estate investing. I'm your host, Damon Santamaria, and my goal for each show is to provide you with some practical and inspiring information so that you can create a solid financial plan for yourself. So to help you on your journey, I want to give you a free copy of my book entitled How to Acquire Your First 10 Investment Properties. And this book is a personal journey from me literally being broke to creating my multi-million-dollar business. And to pick this up, all you have to do is go to stackinghouses.com/book. And while you're there, you can check out our blog as well as a great training webinar where I outline the step-by-step process that I took to get started in real estate. So one of the key strategies of investing is to take advantage of leverage in the form of a mortgage loan. But with the Fed signaling several rate hikes over the next few years, how should we as investors think about rising interest rates? To break down all of this and more, we have Aaron Chapman with Security National Mortgage on the podcast today. So Aaron, welcome to the Stacking Houses podcast. How you doing today?
Not bad, man. I appreciate you inviting me on and allowing me the opportunity to speak to your audience.
Absolutely. So let's just jump in. Tell our audience a bit about your business, where you're located, and also, how you got started in mortgage lending.
So I am located in Arizona. Interestingly enough, I don't do a lot of business here. It used to be that it was centered on what business I did do. But since I started working with the real estate investor, and they did come into Arizona in 2009 and then shifted to go to Indiana, then Texas, Missouri, and they just started moving around the country. And I just started following the real estate investor with my licenses. And what's interesting is I did 1,376 transactions last year, and I think less than 10 were in the state of Arizona. So wow. Most of my business is the South, the Midwest, all your places where people are buying investment properties and finding cash flow. So how I got into it, right? And that's all conventional lending. I focus on the conventional because there's a lot of great institutions out there doing some great things with the non-conventional things, right? Considered non-QM, which right. is in reality the same as the old, not quite subprime, but Alt-A and subprime, if you will. It's just not conforming conventional deals. So I focus there because my opinion, this is Aaron Chapman's opinion, there's no facts behind it. I mean, the facts will be found by the people that are experiencing it, that there's no real good lender out there for conventional investor loans. They're just not that good at it. The banks have really screwed it up. So I was able to carve out that niche. Now there's a couple other people playing in the same niche. They're doing a great job. Sure. So it really boils down to who does a person want to work with. So here's my opportunity to explain why me or why my team. I got started in 1997. To answer the other question is how I got here. I had a background, in high school working on a cattle ranch, from there to the oil fields of Wyoming, from there to running heavy equipment, driving truck. And then I found myself in the mines of northern New Mexico, which I freaking love that mining job. My dad was a miner all my life growing up until we did the cattle ranching thing. Then the partnership went bad. My dad, being Irish, was like, well, I'm done with this, right? So he moved on. And of course, he went back to what he knew, which was working in the hard rock mines, drilling and blasting and all that kind of thing. Really, really hard work, but awesome work, right? So I had an opportunity to go try it out. So I thought, this is going to be great. This is the one thing I've always wanted to do as a kid, and it was rough work. That first run of 13 shifts was brutal. But the second run, my body started to adapt, and I started really, really enjoying the work. To where it's just you and a rock face with this rock drill that looks like the jackhammers you see on the street, that 90-pound jackhammer, but you got to elevate it with a single air leg that gives you pressure, and you hold it and you drill into the rock. Then you got to pick that up and carry it out. It's like 160 pounds you're pulling out of the.
Yeah, you got to be in shape to do that kind of work.
Amazing shape. These guys, you just don't fight with a miner. They will whoop the shit out of you while they're eating lunch, right? So these guys, we were doing that job, and I absolutely enjoyed what I was doing. And then they started shutting down the project. And since I was one of the newer guys, they got rid of a run of us newer guys. I came back to Arizona thinking, I can get a job all day long, where I got a hell of a resume with all these types of different disciplines. My dad was one of their best, so they kept him on, and one longest with them. And I came back and I couldn't find a job to save my life. I had a wife, I had an infant son. I went everywhere, and I kept getting this one word, which would just was the worst word to hear: overqualified. My qualifications were far superior to what they were looking for. And then I finally got to a point where the only job I thought I could get was this $10 an hour truck driving job, hauling landscape rock. So I went to that place and I got the exact same response. So literally, I'm so damn broke, I did not know what was next. And I'm wiping my tears away as I'm walking to my truck, a 23-year-old broken man, if you will, literally and figuratively, if you will. And I get into my truck and I start it up and start to drive away. And I had a coupon for free diapers. So I couldn't even afford diapers at this point for my kid. And he was just about out. And as I'm driving down the road, my gas light comes on my truck. Well, as I pull up to and I didn't know how far I could go with the gas light. So I just found the first grocery store that had a gas station, pulled up to a pump. The only form of payment I had was a debit card. It got a decline because I had an overdrawn account. I started rummaging through my truck, finding change. I started walking that parking lot, and I found enough change to get 2 gallons of gas. Now, this is 1997. So, 2 gallons of gas were pretty easy to get with change back then. You can't do that now.
Probably $2, right?
Yeah. It was a couple bucks. I mean, now today I could probably wander for a day and a half and still not find enough change because nobody carries any anymore, right?
Yeah, I know.
And gas is, 2 gallons of gas is like $10,
right,
or $8 or whatever it is. So it's way different world today. So I went in there, got the corresponding diapers associated with my coupon. As I'm walking out, I recognized the face coming in. He asked me how things were. I just explained to him what I explained to you. And he said, "Hey, let's go to dinner tomorrow night. I'm going to tell you about something." I'm like, "I can't afford dinner." He goes, "No, I have a gift certificate for Red Lobster from a client. Let me take you." So this is pre-gift cards, right?
Yeah.
He had my wife come. We went to dinner with him, and he told me about the mortgage industry. He slid me the business card for a branch manager of a local brokerage. And I had no idea what the word mortgage meant. I just remember as a kid, you're watching those TV shows where the old man and the old lady are losing their farm to this thing called a mortgage. Right. All I knew, it was a negative. Well, so I started there as a telemarketer after I went and interviewed these guys. I cut a foot off of my hair. I shaved. My mom bought me some clothes so I'd look professional. And as a telemarketer, man, it took me like 2 months to make $100. It was miserable, but I stuck with it. And now, 2022, last year, like I alluded to do before, I closed 1,376 transactions, or 1,378. Last year was 1,311, I think it was, or 1,312. The year before that was 700 and change. So we're growing and we're expanding. We're doing some amazing things. And that's when a person looks up the production of a loan originator. That's what I'm called, a licensed loan originator. The average person in my space does 2 to 3 transactions a month. I'm doing between 6 and 7 every working day. And wow, it's all my sources of business. I don't have other loan originators. I have a staff of administrative staff. I don't have anybody else out there ferreting business. It all comes from my referral sources.
That's amazing. And obviously, the real estate investing business is what I call a big, small world where, it's a relationship business where, it's all about who getting referrals and having that repeat business. And that's, part of the purpose here of Stacking Houses is, we help create a network of professional individuals, people like yourself, that our investors can go to that have been in the business, have worked their way up, and are extremely knowledgeable. And so that when we make a referral to someone like Aaron Chapman, we feel extremely confident that they're in good hands. So, if you would, if we could kind of pivot a little bit, if I'm a new customer or even an experienced investor that's never worked with you before, kind of take me through that process of, maybe applying for a loan all the way through to the closing table as well, if you would.
Sure. So real quickly, kind of go back before the pivot, you'd mentioned about, you hand people off and trust that the deal's going to get done when you hand them off to Aaron Chapman or people like us. I had been asked one time what drives me. And that's truly that. I want a person that if Damon's willing to if you're putting your name next to mine and say, "Hey, call this guy," I have to be better than what's anticipated to make you look like a rock star. Yeah. Right. Because if you look like an idiot because you handed my name off, that doesn't help either of us at all. So what I found is that the more we work harder at becoming better at what we do, the better we make the people look that referred us. Because then that person will call back and say, man, you're so damn awesome. I can't believe you hooked me up with that guy. Thank you. Right? That gratitude becomes an economy. In fact, I have 4 little books out. One of them is about gratitude because it is an economy. And it talks about that. When you express gratitude to somebody, then they got to express it back. It becomes this back and forth and all benefiting everybody. So one, I wanted to touch on that. When it comes to doing business with us, the easiest thing, right? Just reaching out to us. Go to my website, aaronchapman.com. If that doesn't work, go to aaronbchapman.com. So sometimes the B works and doesn't work on certain servers. I can't explain what the deal is, so I have them both. Goes to the same place. You'll find this bearded redneck sitting on a porch. That's my office in Missouri, which is a cabin built in the 1800s. I got 2 of them there that acts as my office and living quarters when I go back and forth. You just find the Apply Now button. The other things you want to go on there is go to the Loan Process tab. Click on that. It'll take you through our process, which is more or less just filling out an application like you would do with anybody else. Right. Once it's completed and you submit that and you get that email saying it's submitted successfully, a member of my team is watching that. They'll download it, they'll review it, they'll send you an email with next steps, which is instructions on how you upload your income and asset data to the file, and then upload that income and asset data to the file. Many times clients will say, well, why do you want all this for just a pre-qual? Because a pre-qual is really what gets things started. If you have a really poorly done pre-qual and you start going into making offers on houses and inspections and appraisals, you're spending money and you could be at risk. So what we do is we go through a massive amount of steps up front, and it can be frustrating for a person who's not prepared for it. You're familiar with the term underwriter, correct?
Absolutely.
Okay. So an underwriter is the person who's typically blamed on week 3 as to why the deal's not going through, right? Or why we need all this paperwork.
Yep.
Well, to try and circumvent that problem, what I do is I hired underwriters to do my pre-quals. And one of them, she was the regional underwriting manager for several years. She was the boss of the underwriters that we work with, right? At one point. So she's handling all the real hard pre-quals. So we put a person through looking at your income as far as tax returns, everything, assets, credit issues, all that stuff, and ironing it out well in advance. So when you make that offer, it just goes through as much as we can make happen, because sometimes you can't see everything up front because you have to process a file entirely to see a lot of the details.
Right.
But we try and iron a lot of those things out up front. So that's how we have created a very successful business, is to become very stingy with the pre-qual process.
Yeah, definitely. And that's, one of the things that we teach in Stacking Houses Academy, our real estate investing course, is, set up a Dropbox or, Google Drive and have all of those documents, ready. W-2s, pay stubs, bank statements, et cetera. I know bank statements, you got to keep that up to date, et cetera, when you upload those. But, it's good having all of that documentation ready to go, because it is a lengthy process, and it can be frustrating for newer first-time investors that, why do they need all this information, right? It takes forever to gather all that. Well, if you do that before you even, go to apply for a loan, it'll cut down that process tremendously, I believe. That's been my experience. And you just, you'd rather have it front loaded on the beginning to get all that out of the way, so that, when you go to actually underwriting, then it's more of a seamless process, right?
100%. You want to make sure that you get everything out of the way that you can initially. So it seems like pretty cumbersome, but it's really not up front.
Okay. So once, they submit the loan application, it goes to, underwriting, or what does that process look like from the time all that documentation is sent to you to actually closing?
Well, once that stuff is in, we anticipate a pre-qual letter to go out with about 72 hours, provided everything is there that we need. And then person finds a house, they sign a contract comes into my team. We have a specific email address just for contracts, purchase.contract@snmc.com, SNMC as in Sierra, November, Mike, Charlie.com. When it goes in, they review it, they download it, they build the file, they submit it to their team, and starts going through the process. We have a specific person that if it's ready for appraisals, we ask these questions up front. We'll ask a detailed list of questions up front to verify all the things we saw in the contract are accurate, right? Because things change in negotiations that sometimes we don't see. We get frustrated people back, say, well, we sent you the contract. I know, but things happen, right? I've been yelled at the day of closing. Why didn't you guys change the loan to match this? Because you never sent me the addendum. So we ask up front, is there any other addendums? And we ask if it's appraisal ready, because I have a specific person that orders those appraisals and tracks it. Appraisals are really tough right now. Then we run it through the process, get it closed, right? That could be closed within 30 days, but what's taking a long time is appraisals today. We're trying to find ways to cut that down, but right now we haven't found the best way to do that. There's only so many appraisers, and there's a lot of demand of that market. But what our main thing is to help investors become successful. There's this old saying, good judgment comes from experience, and experience comes from bad judgment. You've heard that?
Yeah, absolutely.
Yeah, and you smile because you know what that means. It means you've done a lot of stupid crap that's made us smart. The goal that I have here is to help other people learn from other people's mistakes. So when I'm doing thousands of transactions a year, I get to see where a lot of people are making decisions, where they succeed and where they fail, right? Yeah. I don't need my clients to learn from the failure piece. I need them to learn from other people's failures and other people's successes and make decisions based on practical data, not speculation and theory. So that's one of the things we guide them through, the process of where we've seen other people be successful. The other thing is to get their mind right. You have to change from a consumer's mindset to the CEO of a real estate investment business. And with the CEO of a real estate investment business, it's not about looking at a pro forma, which is going to give me the best cap rates or cash on cash return or that. That's not what it's about. Every business that is successful is based upon relationship. You've got a good group of people helping you source the property, rehab the property, manage the property, maintain that property, and keep renters in that property. The property you buy, which is actually a business, can it stay reasonably rented for the entire time you own it? Can you raise rents on that? If you can do those things, you are going to become successful. If you are going to chase rates, if you're going to see who's going to give you the cheapest deal, or how can I find a deal and cut out all these other people so I can get the best price, you will never find the ability to become successful because you're not using the proper formulas of success, right? And so what I really like to get into in the depth of is where the real value of real estate lies, right? Especially in the finance part of it. Too often people get wrapped up into thinking that, they really try and follow a lot of the Kiyosaki thought process. And I can't say it's wrong. It's definitely good, but can you achieve it right now, which is you make money on the buy. So they take it from his perspective as you got to buy it for way less than what it's worth. Can we find that type of deal today?
No, absolutely not. It's so incredibly difficult. And I'll tell you from firsthand knowledge, most every property that I've bought, I didn't buy it 20% below market value, and I'm not flipping. I'm a long-term buy and hold investor. I'm not flipping properties. So, maybe that kind of is calculated into the equation. But I'd love to hear your philosophy on, buying it right, keeping it full, financing it right, and the relationship portion, because I think that's what our students need to hear.
So when you're talking about making money on the buy, it really just boils down to what are you investing into it to acquire, right? So when you think about it from the right perspective, a 20% down conventional loan, you're literally making money on the buy because all your investment is 20%. You're not going to find that 20 or 30, 40% below market, because that's like having a steak walk through a complete pride, a full pride of lions. Only one's going to get the damn steak, right? So there's too many out there looking for it. You're not going to find it, or you'll rarely find it. You got to be out there on the field working to actually stumble into those. But for the most part, you can find properties you can buy at market value, put 20% down. If you're putting 20% down, who's putting up the 80?
The bank.
The bank, right? Yeah. So if you bought the property the way you were supposed to as the investor, that you can keep reasonably rented for the whole time you own it, right? Who is the one who pays back? The investor. Excuse me, the lender.
The renters.
The tenant, right? So the tenant, they're going to pay back that loan for you. So if the tenant is paying back the loan, think about this. Let's take a $100,000 purchase or $100,000 loan. Let's just do that, right? We're going to divide that by 30, right? Actually, let me change the baselines. Let's do a $100,000 purchase price because it'll be easier numbers. $100,000 purchase price. You're going to put 20% down, which is $20,000. You're going to have an $80,000 loan. You'll divide that $80,000 by 30, which is how many years it's going to take your tenant to pay it off. What number do you get?
I'm sorry. What are the numbers again?
I've got it for you if you don't got it, right? So you have to get your calculators out, folks, if you're listening. So it's $2,666.67. That's what you're going to get. So over 30 years, your tenant will pay down an average of $2,666.67 of that $80,000 loan. Now, I know there's an amortization table. We're talking about just averaged, right? Yeah. If you divide that into your investment of $20,000, it means your $20,000 is growing by 13.33% of the original $20,000, right?
Which is amazing by itself, right?
Which is huge. And if you factor in, some costs, let's say $5,500, now you're going to be at somewhere right around a 10% return. Still huge, right? That's just on them paying down the loan, right?
Right.
Now, what about if you raise the rents, right? Let's say, what we're raising rents by right now in the United States?
It's got to be a large percentage. I know it's probably just depending on which news source you're looking at today, but I know rents are going up, and it's across the board.
So what I have found when it comes to the rents right now, we're seeing them going much as 10% across the country, right? So there we get the huge jump, 10% throughout the United States. I've seen some places higher. I'm in Arizona. We're seeing 30% in some places. Now, there's some places that are having massive decline. What city do you think, or at least the last I've read, it may have changed by now, but what city do you think has the most declines in rents right now? The biggest declines in rents?
San Francisco. I have no idea.
Close. Minneapolis, Minnesota.
Oh, okay.
Why would that be? What's going on with the cops out there? That's where we had the riots. That's where we had the George Floyd protests. That's where they're burning down police stations. Right. People don't want to stay in a place like that, right?
Yeah.
So as a result of that, when you start risking law and order, you start risking property values, all kinds of things. So to keep people there, they dropped rents as much as 17% last I read. It's been a little while since I've read that. That's significant, right? Yeah. So we're seeing an average of 10% across the country. So for the purposes of our equation, we're just going to use 3%. Okay. Just a minimal 3%. So let's say you're renting that $100,000 property out for $1,000 a month, and you're getting $200 a month cash flow. What is 3% of 1,000?
$30.
$30. Nothing sexy, right? Nothing that's going to get you, the investor, excited, but nothing also that's going to get your tenant excited. They're not going to be like, hey, I'm going to pay that other $30, right? When they know the rest of the world's raising them by hundreds. So $30, right? But conceivably, if you're getting $200 a month cash flow year one at $1,000 a month, now you're getting $1,030, barring any major changes with insurance and taxes. Let's say you get that $30 as cash flow, right? So now you went to $230 in cash flow. What percentage did your cash flow go up by?
That's a good question.
What's 30 divided into 200?
6%.
It's actually 15.
15%.
15%. Every time you raise rent, you get a 15% compound growth in your cash flow.
Per 3% increase?
With just a 3% increase. How awesome is that?
Yeah, no, it is awesome. And not to shoot your theory down, but when you raise rents, typically it's the value of our properties are going up, and we're seeing, tax increases as well. I know on a lot of my properties, the taxes are going up. So if you're not raising rents, you're losing money every year, in essence, if you don't raise your rents.
If you don't raise rents, you're going to lose money. There's no two ways about it. Now, you are going to see now, especially in today's environment, with property values doing what they're doing, the tax authorities are going to take advantage of it, right? They're going to say, hey, let's just go get what we can get. We did see it a little window there after 2008 where they were dropping taxes, right? Because property values, right? So we know where that's going to go, but never did we see rents drop, except for places like, where there's massive exoduses. That's a whole different animal. So we got to be cautious. But the reason I bring up this is not to just be all about the rate, because that's on a 3%. Well, if we're raising 5 or 6%, you still have the possibility to see that 15% compound growth in your cash flow, even with an increase in taxes or in your insurance requirements. Sure. But here's where it really starts to get sexy. Does the lender get to raise the payment on the loan because of inflation? No, they are stuck accepting the exact same dollar amount every year for the next 30 years, right? So here's just where I'm going to share a screen here with everybody. Now, this is a tool that I had created. The professor of accounting at Kennesaw State University is a friend of mine. He heard me talk about this on a podcast and talked about inflation-induced debt destruction is what one man likes to coin it, and I've heard others say, but nobody ever put numbers to it.
Jason Hartman himself.
Yep, Jason Hartman himself is one who I've heard, who was the first person I heard say that phrase.
Yeah.
So what I did is I decided to put numbers to it because there's a bunch of people talk about, but nobody's got any equation to do this. So this is what we've got here. So we're going to do this $100,000 loan, right? $100,000 purchase price, $80,000 loan, 30-year fixed, with payments of $479.64 per month. That's a total of $80,000 principal and $92,670 in interest, for a total of $172,670.55 principal and interest. Now, what is the government saying the inflation is today? What is CPI?
They're saying it's a lot lower than it actually is.
Yeah, they're claiming it to be 6.8%. If you look at John Williams' shadow stats, you're going to find that he says it's about 15 when you look at their charts. So we're going to use their BS metric that CPI is, their engineered inflation, to be 6.8%. And with that, we get to see here, this column, it shows every time you make a payment on the loan, your dollar is losing 0.5% in value, right? Every time you're making a payment. So we recalculate every single payment for the next 30 years. So it shows 360 payments for a total of $172,670.55. After 360 payments, the inflation adjustment at 6.8% is you've only paid back $73,572.92 in actual dollar value.
Yeah.
You paid back less than what you borrowed.
That's amazing. It's amazing. Yeah. And few people really understand this. So I appreciate you shedding light on how inflation can certainly affect, the mortgage and real dollars, right?
Yeah, it makes a ton of sense. Now, what interest rate do you think this is at? This is where it really starts to get eye-opening, because right now we're seeing interest rates in the mid to low 4s because of where the rates are at. We've got them as low as the 3s. What rate do you think I'm quoting here?
6%.
6% is exactly what it is, because you're cheating and looking at the screen. So we're using a 6% rate, guys. If this sounded sexy a few minutes ago, it's even sexier when you look at what we got today. So the reason I talk about this, the reason I bring this up, is because we are getting so wrapped up in thinking we've got to find the cheapest everywhere, and that when the rates go up, it's all going to hell. That's not what's going on, guys.
Right.
Because rates will go up to try and curb this inflation. They have to. If we've got lumber at the all-time high, if we got everything, steel's at an all-time high, everything you go to buy is more expensive than it ever has been, gas, all these things, why would interest rates not be? But they are presently. Right? When you look back on the history, the only time it's been lower was during COVID. When COVID hit in March of 2020, because of that, we had this massive decline in the mortgage-backed securities because banks were selling out their positions to pay for their margin calls on Wall Street and all these other reasons that happened.
Right.
$1 trillion got dumped in by the Federal Reserve from March 20th to March 30th. And then they kept billions and billions and billions of dollars a day going in there to keep those rates artificially low. Well, that's history. Quit looking behind you. Let's look forward. What we're looking forward at is high inflation. We're also looking at long-term leverage that gets paid off by that inflation. And as you can see, even if we hit 6%, it's not going to hurt because we're over 15% inflation right now. And I'm quoting that number that you're paying less than what you borrowed at a 6.8 inflation with interest rates 1.5 higher than they are today.
Right.
So leverage high, leverage long, pay off slow, quit jerking off and spending all this time on things of zero value. Now, how you can get this for yourself, because this is a tool that only exists on a couple computers. This tool exists on my computer, the creator's computer, and one person's computer on my team. So here's what I'm going to show you. You can go to your app store and search for the QJO Investment Tool. This is what it looks like. Anybody can see the screen. Search for the QJO Investment Tool, which stands for Quit Jerking Off Investment Tool, which is what people is doing when they're wasting time on things that's not going to help them. When you get there, and you download that tool, it's going to look like you're going to get let me see here if I can get this thing to work. You're going to get that pops up there. That's the company that I have, STOC Inc., which is Silverback Grill on Coke. That's how I approach my business, like a coked up silverback, if you couldn't tell. Then you can see multiple calculators on there. Asset reserve calculator, a calculator to actually pull your Schedule E cash flow off your tax return. So when your CPA is doing your Schedule E for your real estate, you can plug in the numbers and see if you're going to be a positive number or a negative number when you add back in your depreciation and what a lender will see, right? So I've got that calculator for you. There's also the subject property reserve calculator on there, but the one we're going to target today is a mortgage amortization schedule calculator, which is exactly what I just showed you in the tool, but I condense it down to an app. So we're showing
real quick. Is there a desktop computer version of?
There's not a desktop version of this yet.
No, just the app. Okay.
It's being worked on though. So On the app, it works both Apple and for Android.
Okay.
So there's just 4 fields to fill out when you get to the amortization calculator: the down payment, the purchase price, and the interest rates. You can play with all that. There's also an additional payment if you want to see what effect putting more money into your mortgage will do for you. Use it just to play with it, but I encourage never, ever pay more than you have to, because you're giving them money while it's worth more. Keep it and use it for your purposes. So when you calculate, you're going to also be able to go, it'll give you all your figures, but then go up to the upper right-hand corner when you calculate. There's going to be what looks like a little calendar icon. You click on that and you can scroll forward to 2051. Well, this was a shot. You can go to 2052 now. This was, I copied this last year. You go back forward 30 years in advance and then save and close that. And you can see what the effects are 30 years from now. So you can see November of 2051, where I did this screenshot, what the principal and interest payment was and what the inflation adjusted payment is. Meaning in this example, it's showing a payment of $763.86 as your principal and interest payment. But that is, you will need $763 to buy the same items you buy today for $69.85. That's how inflation is eroding the dollar. That's what that is illustrating there. But if you go further down, you'll see the total payments to date. In this example, they're paying $274,991. The inflation adjusted payments is only $104,000. The person who is doing this loan borrowed $150,000 is 20% of $200,000. So no, it'd been $160,000. Sorry, maybe. Yes, $160,000. Yeah, my mind was going blank here. Okay. $160,000. So they paid $274,000 of that, but they only their inflation adjusted payments were $104,000 because of what inflation did to erode that dollar.
And what's the default inflation rate inside this app?
In this app is 8%. I bridged the gap between the CPI and the inflation at the time that I built the app, which inflation at that time was about 12%. The CPI was in the 4s. So I bridged the gap. Now it's actually way higher than that. So, so we're even very, very, very conservative with this, and we'll change it as we need to. But we're building another app version where you can play with inflation. All of this. This is just a free version for a person just to see in reality what's going on with your purchase.
Aaron, this has been awesome. You know, again, this is an area of the real estate business that, again, few newer investors really, it's hard for me, who I've been doing this for close to 10 years. It's hard for me to really get my head around, you know, how inflation can affect, you know, the actual amount that you pay for a mortgage, you know, and to your point, you know, people are so concerned about, you know, a 1/10%, you know, they're missing out on the big picture, right? And so I think partnering with someone with your expertise, someone that you know our customer base can grow with and be educated on, like you've done here today, is absolutely tremendous.
Well, thank you. And that's our intent, to make sure that we educate people to an extent beyond what they thought was possible, right? Because of the realities of what we've experienced. Also in the same app, if you're in the app, you don't have to search out my website. Just go up the little question mark in the upper left corner of the app, and it'll take you right to the site.
Okay, perfect. Well, I you know, in the interest of time, I know we're coming up here on the hour. What other information would you like to share with our audience? I know that you also are involved with several charitable organizations. Feel free to, you know, elaborate on any other information that you'd like to provide related to real estate, or talk about your charitable organizations as well.
So, you know, we support Operation Underground Railroad with our in many different ways. So when you go to the website, you know, aaronchapman.com, you scroll down, there's a donate button there, and that'll take you to a campaign that we have. I believe we've raised about 42 or 43,000 there just this last year. But I also contribute $50 for every transaction that I close, which is, this last year was about 72 or 73,000, if I remember correctly. And then from there, and we actually did a little bit more than what we would have done. Because it's 1,300 transactions. We had to hit 1,400 to 70, whatever the thousands were. We put a little bit extra in there. But then other companies that I have, you know, I've got a website, I've got a YouTube channel and a few other things, and my partners, we contribute another 50,000 from there. So we've been able to see a lot of capital going into aiding that. And it's really to support those people who are combating human trafficking directly on the front line. So we're supporting OUR and other groups associated with OUR to get the message out and to also help fund the operations. So the operations are funded strictly off of donated capital. These operations are people going into ugly parts of the world and pretending to be buyers of other humans. So if you're familiar with the human trafficking world, a lot of people know they're slave for labor. That's been the slavery battle all along, was the labor piece of it. But then there's the sex slaves. We've heard about that. So it's not as, there was a time when that was like, wow, that was really alarming, but now it's so normal that it doesn't alarm people as much. But when you start hearing that there's also, people being held in slavery for organ harvesting, they're selling their organs and keeping them alive long enough to get all the vitals out of them. And then you hear of the human sacrifice, that there's actual people being held and things are being cut off of them and hung over businesses' doors for good luck. Lucky rabbit's foot isn't enough for some of these people. They got to go to that extent. So there's a disgusting world that we live in out there. And the thing that's the most disgusting to me about this is that the guys are able to infiltrate these organizations as buyers are U.S. citizens. And the reason they're able to do it is because the U.S. is the highest consumer of all of this. It's absolutely amazing to me that is the case. And so it's hard for us to wrap our head around this, but think about what we're experiencing today, right? We just had one of the most highest profile trials in the history of mankind, but yet we saw nothing about it. So it does bring to question who is involved if they're not even putting a light on it whatsoever. Nobody's talking about these things. So it goes to show that it's very, very, it's not even probable anymore. It's reality that those are the groups of people that are actually causing a lot of this, creating the markets. It's the fastest growing business enterprise on the planet right now. It's worth $150 billion a year. And to bring $150 billion to an understanding of what that looks like, that's enough to buy every NBA franchise, right? So enough to buy every Starbucks franchise and put every college age kid through college and have money left over. That's what $150 billion does.
It's amazing that it doesn't make more headline news. I live here in Houston, and occasionally we hear about local stories like that. But I'm glad to hear that there's folks like you that this is obviously something that it's hard from even a grassroots effort to have a huge impact when you're dealing with $150 billion of headwind, I guess, toward you. But
it's $150 billion a year. Everything we throw at it is really not even drops in a bucket. It's so minimal, but it's a matter of every single person within earshot saying, okay, I'm done of hearing this crap. We need to do something about it. We've got to stop this. We've got to take the people that are getting away with it and be sure that they can't get away with this anymore. And I don't know what we do other than we just raise hell, as much hell as we possibly can. Is our world too far gone? I don't know. All I know is I'm not too far gone, and that's all I can control. I can't control anybody else. I can control Aaron Chapman and what I'm going to do about it. And so I'm going to make my voice heard, and there's more to come. I'm very, very close. I've gotten very, very close with all these these people in the organization. I've gotten close to a lot of their operators, their management, the founder. We become very close, and still see a lot of me in a lot of places going forward because of the relationships that we have built.
Well, again, I'm glad that you've kind of opened up our eyes and our audience eyes to what reality is. And unfortunately, there are a lot of, dark parts of our culture that unfortunately it's not always pleasant to think about. So thank you for your crusade and your fight for such a great cause.
Well, I appreciate you allowing me the time to talk about it, and just tell everybody, listen, you don't have to do anything other than try and support. And if you don't know where to support, you go to my website, aaronchapman.com. You can go to quitjerkingoff.com, and you can go to the store. Anything you buy there goes directly to that. We have shirts that are actually for that, which we got some pretty good logos and designs. If you want to go to Amazon and buy, I've got 4 of those little books out. It's the QJO initiative, as in the Quit Jerking Off initiative. And my author, Aaron Chapman, there's 4 books. Every dollar for that goes to another cause, which is called the Len Foundation, which is for cerebral palsy. There's a lot of children that have to deal with that. So everything we're doing is trying to help kids and help people that are disenfranchised.
That's awesome. Well, it's service with a purpose, and again, I appreciate you educating our audience on the work that you're doing, along with obviously all the work that you're doing for real estate investing as well. So, with that,
we got to have a cause behind our business, right? I refer to that as being a cause capitalist.
Yeah. So again, just really appreciate your time here today. The Stacking Houses family thanks you, and until next time, happy investing.
Thank you, Damon.